tell you what, we have a lot to cover today. So, and this is going to be a good one. And we want everybody to be as engaged as possible, and make sure that we're customizing the content for you. So please use the Q&A function as much as possible. We will do our best to get to those questions as they come in. We don't always do that. A lot of the time we'll leave the questions for the end, but today we want to make this as interactive as possible. So for those of you that don't know who DMI is, we were founded in 1989, and we're an IMO dedicated to empowering financial professionals, and we specialize in providing personalized support across annuity marketing services, life insurance marketing services, sales consulting, operations. So our mission is to elevate financial advisory practices by offering tailored solutions that foster growth and success. And that's exactly what we're doing here today. We have Brian Kerrigan, who is an expert in accelerating wealth creation. We have Ed Protesi, who's a business valuation and transition strategies expert. And then our very own Tom Perrone, who is our very own DMI business coach. I could talk about these guys probably for 15, 20 minutes introducing them, but I'm not going to do that. But between them, there's probably about a century of experience there in the business and advanced planning space. So let me stop sharing our intro slide here so you can see everybody. But again, use the Q&A as much as possible today, guys. And Josh, who has over 15 years of experience in the life insurance space, helping advisors and agents like you, is here to help, and is also an expert pickleball player. But I'm going to hand it off to him and let him talk about the agenda today a little bit.
Intermediate pickleball player. I'm getting better every week, though. I'll say that. No, but thanks everybody for coming. There's obviously tremendous opportunity to work with business owners and high net worth clients, both in the amount of opportunity that's out there and also the size of the opportunities as you come across them. So the idea of events like these is so that you don't feel you need to have 30 years of experience under your belt before you start approaching business owners. We can help you stand out in the business market now by coming to events like these, and then ultimately leaning on the expertise and the resources we'll provide you at DMI so you can immediately stand out in the business market, help your business owner clients. They need advanced planning solutions that you can bring to them, and honestly make good money doing so for your practice. So everybody wins. So without further ado, and as Glenn said, this is a roundtable. It's going to be more conversational than other webinars you might have been on lately. So keep the questions coming. Maureen will moderate that, and we hope to get to most of them, if not all of them today. But with that, I thought a good place to start would be that the results from the election have been in for a few weeks now. And any industry you're in, you're wondering how that might affect your business. So I thought we'd start by asking you guys, what potential impact, be it a good impact or a negative one, do you foresee with any future policies and the incoming Trump administration?
Yeah, I guess, there was an expectation if Trump lost that there would be significant tax increases across the board. Now with obviously Trump being a Republican in the House and the Senate being controlled by Republicans, we're not expecting the 2017 Tax and Jobs Cut Act to sunset and reinstate the previous rates and the previous estate tax exemptions, which are lower, which were lower than, they would have gone up on 1/1/26. So we're not expecting that. We're expecting new legislation. I expect that at a minimum, the rates will stay where they are. The estate tax exemptions will probably stay where they are and be indexed for inflation. I think income tax rates will probably stay around 37% in the top marginal bracket. Capital gains rates could go down. We've heard a few things about that. and potentially corporate tax rates could go down. So there'll be more to come, after the Trump administration is in, but it doesn't look like there's going to be meaningful tax increases over the next 4 years.
And with that, I might add that there's a lesson to be learned by the fact that we had heard from the Democratic side of the aisle that what they planned on doing if they won, and they really were going to lower the exemption credit. I had heard 3.5 million, whether they did or not, I don't know, but it kind of gives you a very good idea of what may happen should the Democrats get in after the Trump administration. So what does that tell you? That tells you that right now we have a great amount of opportunities to use exemptions to move property away from the estate tax exposure. And we have time to do it, where a lot of people weren't doing anything and they were going to wait till this year had the Democrats got in, which it doesn't give you a lot of time to do planning. Brian, myself, and Ed would tell you, when you start doing planning to exempt property or freeze property or transfer property, it's something you don't do in 30 days. It needs time. So this is a great opportunity that we have today to start shifting assets that are growing substantially in your estate and shifting to other members of the estate community.
I agree with Tom and Brian on that comment, and I think one of the things to consider is typically in the off-year election in 2 years, there is usually a change of perhaps parties in terms of Congress. But one of the things we may need, maybe that time frame is maybe not 2 years, not 4 years, rather maybe it's just 2 years, and that there's maybe there should be more of an emphasis on just that type of transfer planning. We've seen a lot of it over the last couple of years. We'll probably see more as it goes forward, but we have to keep in mind that there may be a change come 2 years from now. So maybe it's only 2 years, could be 4.
One thing I'd like to add, Ed, is and I think we're all in agreement on this. I mean, tax planning really should be a long-term thing. I mean, the reality is you should position yourself and your family so that you can, pay as little income, capital gains, and estate taxes as possible. And sometimes that may mean recognizing gain when there's lower capital gains rates, which kind of runs counterintuitive to the typical tax idea that you want to defer. So, the Democrats will be back in office. Those rates will go up at some point. So, if to Ed's point, if we get to let's say we get to House Democratic control in 2 years, that's basically nothing's going to happen. So the tax changes that are made in February will go for 4 years, but we don't know what's going to happen after that. And honestly, it would have been a real mess if Harris had won. And this is not a political statement. This is just there would have been a ton of planning that needed to get done in that month and a half or so.
Yeah.
Totally agree.
You come back to what were told, and just think of right now we have a $13 million exemption per person. They're talking 3.5. So that really means $10 million of assets in your estate at 40% would have been taxed under a Democratic tax policy. That's a lot of money. So again, Josh, I know one of the things that you like to talk about is how does it impact some of the life insurance products and the planning that we do. And I'd like to talk about that a little bit.
Yeah. And we'll definitely get to that for sure. We won't leave without touching on that. But this is great intel, because over the past few months, our firm and many firms and many carriers have sent out a lot of messaging on TCJA and the sunset. But maybe now it's not so imminent. We don't know when it's going to happen, maybe not as imminent as we may have thought it might be, but nonetheless, the danger is people being lulled to sleep by it and not doing planning when they should. So great information. Now, I know one thing that is always an issue, no matter what the political landscape is, no matter what the tax landscape is, And that's valuations. Valuations are always important. I think we're all in agreement that you'd be mistaken to assume that a business owner knows what his valuation is. He either doesn't, or he might be wrong about that. He or she might be wrong about that. So give us some insight on the importance of it and what are the consequences really of being wrong when it comes to a business owner's valuation.
Wow, that's a loaded question, huh? When you really think about it, the first thing that pops into my mind is simply, what happened to the family wealth? Is it going to get realized to the extent that the business owner thought? And your point is so important. I would say maybe 90% or more of business owners really have no idea how much their business is worth. In fact, they're probably estimated on the high side. Brian, what do you think?
Oh, they absolutely are estimating on the high side. And unfortunately, the first time that they actually understand what their business is worth is when they do some sort of valuation for family planning, or they go to the business broker with the, I can't do this anymore, and I want $10 million for my business, and my business is worth $4 million. So, I mean, those are fact patterns that, you know, we all want to try to avoid. If at all possible.
So sentimental value doesn't play into business valuations then?
No, sweat does not necessarily equal money.
It's true.
You know, Ed Protesi has a great saying that I learned from him. It's, I don't know how many business owners have told me the value we're going to use is the way the industry value that they use, their formula. And Ed says, oh, that's a rule of thumb, and nobody's ever a rule of thumb. So you can't be surprised if what you think you're going to get, you don't get if you haven't put the time and effort to do what Brian does to get the multiples up. You know, and it's saying because 80% of the businesses will not sell, and maybe more percentage will never sell for what it really is worth. When you add that, and then you add that 79% or close to it of business owners don't even have a buy and sell that's funded. When we talk about business that tells me that the business owner's not getting planning done by their current advisors, their attorney and their accountant. So this is a great opportunity for advisors who like to plan to start talking to their business owners about these stats and start talking about how they can do planning and build their multiples, fund their transition plans, and really put something together where, you know, that's where it all starts. And of course, then we look at the tax implications, and now we have a lot of room for that. So this is a great opportunity for a planner.
Yeah, and I'd like to stay here on valuations for a second, because first of all, I think it's one of the best conversation starters an advisor can have to approach a business owner. So tell us more about, you know, the advisor's responsibility, how the advisor can assist, what are the reasons a evaluation is important, and any questions they might ask to get a business owner thinking about that.
Well, the biggest thing for me, I'll take the simple, and I'll yield to you, Ed. I mean, I'll take the simple answer. It's extremely hard to do an accurate financial plan without knowing what the value of the business is, because in a lot of cases, the business represents about 85% of the business owner's assets. So, you know, when you're talking about what is that retirement going to look like, I mean, obviously you want to diversify away from the business so you don't have all your risk there, but you are going to have a significant amount of assets. And if you're off on that valuation, you know, you don't qualify for the rule of thumb and you're underneath it, you could be unfortunately in for a rude awakening when it's time to retire.
Exactly, which goes back partially to that wealth accumulation or wealth realization, which is a term that I've used in a number of different contexts. But it's really important. It provides an insight into retirement, into wealth actualization, if you will, but also talks about life insurance as well. What are the true life insurance needs, and how does that intersect, if you will, with a buy-sell agreement if you have more than one owner, and what's the plan going forward? the valuation sort of sets the framework, if you will, for a lot of that planning. And that's really the key. It's also important from a perspective of, what if you plan on selling? Do you really want to understand what your business is worth in the marketplace, what it's worth for fair market value, i.e. internal revenue service purposes? And do I want to sell the business at some point? And how do I increase its value, which goes to what Brian does?
The other thing, there's a question I always ask business owners, and I said, someday you're going to leave your business, you're going to die, you're going to become disabled, or you're going to retire. What plans do you have to extract your business wealth out of your business should any one of those things happen? Now, keep in mind that most business owners have most of their wealth in their business, which is a shame, rather than having their wealth outside the business or allowing the cash flow of their business to create wealth through different exec compensation packages and things of that nature. So, that one question opens up a lot of doors, because that's their retirement. Basically, they've got all their money in that business. And you can't spend machinery, you can't spend non-receivables, you can't spend debt. You got to get money out. So they need a plan. And just like Ed and I just said, the business owners like to be in the action area, which is everything that's going on. And they don't like to plan, but unfortunately they need to plan. So we have a good message to talk to them about it, especially when you use these stats that are out there of the failure of small business owners to plan.
Yeah. And a lot of it details what we'll be talking about in a little while, which is really about owner concentration. When I talk about concentration, some of you probably remember a game show called Concentration. Well, concentration is one good thing, but there's a problem with concentration. If there's owner concentration, i.e. I am the business, what if there's supplier concentration, customer concentration, product? Those are the things and variables that are important from a risk perspective in determining value, which goes back to wealth realization or actualization.
Wow. So valuation has such far-reaching effects when it comes to succession, exit strategies, retirement. So it's really a cornerstone. I don't know how you can do much planning without having a truly accurate valuation. So might be a great place for advisors to start the conversation is through these valuations. Another good topic, and it's been touched on so far, with all of this, I think naturally business owners might put this type of planning off, but even more so if some of these tax laws aren't going to be realized, if that's the messaging that's going to be put out there. So we want to talk about why it's so important for business owners to start planning now. And I thought we'd talk about on this subject an interesting component to this, and that's baby boomers. Now you might be thinking, what in the world do baby boomers have to do with any of this? They've been a target demographic for financial services for many years now. Can somebody explain to me why baby boomers and what's happening right now with them have an effect on small business planning?
Yeah, I can take that one, Josh. The last of the baby boomers are 60 years old now. So if they're going to go out at the ages of 67 to 70, so if they have a 7 to 10 year plan to effectively get out of the business, I have some serious concerns about whether there's enough buyers for those businesses. And because of that, whether there's going to be a devaluation of those businesses, if everybody's trying to go out at the same time. I do think, in my forecast, I do see probably larger companies maybe scooping up some of these smaller companies at reduced rates, and being able to take those assets and drive their business growth higher. But I am talking to some business owners right now about going in the next 3 or 4 years instead of waiting 7 to 10, because we have a favorable M&A environment, and also we have a favorable tax environment at this point.
Nice. Yeah. So on the topic of why sell now, you mentioned 70 to 80% of business owners aren't going to sell. They're not sellable for one reason or another. What makes a business sellable or not so sellable?
Middle management. And there's about 8 value drivers that are very important, but I feel, in my opinion, the reason why they're not as sellable, the main reason for me is that when I buy a business and the owner says, well, we make $500,000, I take $500,000 out of this business, that sounds good. But then when they tell you he works 80 to 85 hours a week, I'm not interested in that business. I want to buy the business and run it the way I want to, which doesn't require me to put a lot of time in. So that means you need good middle management that's going to stay. And that's where insurance advisors and planners come in, because they can develop programs with vesting schedules that'll keep those key people there and give them options either to buy the owner out, run the business as a passive ownership, which allows the older baby boomer to stay there as a passive owner if they wanted to, for an example. So I think if I had to pick one of the value drivers, I would say you need to create middle management, which takes a long time. And of course, there's about another 8 or 9 value drivers that Brian certainly would talk about and Ed would talk about. But that's what I see. That's one of the biggest reasons I think businesses don't sell for their value.
Yeah, let me step in here for a second, because I think you're absolutely right, Tom. One of the issues that I see constantly from the valuation perspective or from representation when we're going to sell a business is the sustainability of cash flow, the sustainability of income. And a lot of the issues that Brian deals with, including recurring revenues, including management, the replacement management, developing a team, developing a product line that is, or product and or service line that is expandable and can grow. Those are some of the very important issues. And it's also about risk. That's one of the key formulas. When we value a business, we're always looking at risk. How do we determine risk? Based on rate of return. Brian, what do you think?
Yeah, you guys covered a good chunk of them. I mean, there's the basic things that you want to look for in terms of having strong financial performance, and that also means the quality of the statements that you have. A lot of people, try to run their business off these internal books and records. They're never reviewed or audited. Now all of a sudden we want to sell to a publicly traded company and there's a problem there. So when you think about financial performance, you got to think about records. Ed, you touched on growth potential. A buyer is going to want to look for growth potential, because if it's a PE buyer, they are going to want to flip within 3 to 5 years. So they need to see the growth potential there. Tom touched on, we don't want to be dependent upon any customer, employee, supplier. Cash flow, you guys talked about. Recurring revenue is a huge one to me. In Ed, in my world, recurring revenue is there every year, and it's much more predictable, so it will really drive a valuation higher. Mm-hmm. The other one that I think is really important is a sustainable competitive advantage. And if you ever listen to Warren Buffett, he talks about having a moat around your business. How differentiated are you from the other businesses in your direct competition lines? To the more different in a valuable way, you're going to get more in terms of valuation. And then the last one that we haven't talked about is customer satisfaction. We generally will do a net promoter score with our clients to determine how customers feel about the product or services that are being delivered.
Excellent.
Yeah, great insight. All of this insight would be tremendously valuable to your business owner clients. They hope to sell at some point, but they may not know the valuation. And if they do, they may not know how to put themselves in a position to be quote unquote sellable when that time comes. So again, if you advisors, agents out there can equip yourself with this knowledge, you're going to stand out in the business market head and shoulders over any other competitor who's just putting a product or a proposal in front of them.
Hey, Josh, can I bring up something that an actual experience that I had when I was very young, probably 30 years ago? 35 years ago, I had a software package that did valuations. I thought I was the coolest cat going. I thought I knew more than Ed Protesi, okay? And I went to a client to show him what the values. I grabbed all the values. Well, when I went back to present the report, which, by the way, I probably didn't know what 50% of the terms meant. I really didn't study it. They had their accountant sitting in the interview. It was the worst interview I ever had. I was ashamed because I knew nothing, but I thought I knew something because I had a software package. Here's my point. There's software packages out there that'll show your client what the value of their company is. Great. That's good. That's just a model to start with. But you need to talk to people like Brian who do these things for a living, and he can pinpoint great valuation. But I tell that story because I think there's a lot of advisors out there that try to do this, and I'm not keen on it, to tell you the truth.
Yeah, and that's a good point too, because one thing that could be intimidating to an advisor is they give them these recommendations on how to plan for their business, not knowing that a CPA may be taking a second look at these recommendations. How do you guys typically view other professionals involved in the business owner's lives, such as CPAs and attorneys, and being able to work with them instead of against them? Are there anything you can suggest along those lines?
Yeah, I work. The first thing I want to do with a client is to bring his people in, because you got to remember the CPA has all the control.
Mm-hmm.
He has all the control. The lawyer, maybe not so much, but remember, the business owner started in the garage with the CPA for the most part, and they're loyal. They may not even like them. So you as an advisor don't want to make enemies. And I found that I tell the advisors, let's all get in the same room and talk about what's best for the client, what I'm doing, what you're doing, and what the other people are doing, and create a team. It works much better than that. You can't be afraid if someone doesn't like your proposal, because if what you're going to do has merit, it will stick with everybody. So I say round up the team as quickly as you can with their current advisors and go from there.
Absolutely agree. I think what you avoid, Tom, in this instance is NIH, not invented here. When you don't have the consensus, if you will, and maybe there won't be a consensus, but at least you can share ideas. That's one of the first things I would always do in evaluations, and ensure that I'm getting with the CPA, also with counsel, and perhaps any other advisors as well. It's really important that we all have the one goal in mind, and that's to help the client.
And the owner appreciates that, because it might be the first advisor ever to say, let's get all the people in one room and talk about your issues, not theirs. Okay. Right. You're spending money with these guys. Let everybody know as a team what we want in common.
Yeah.
Brian, you must run across that all the time.
I do. And you have to, everybody has to work together, because what inevitably happens is, for example, I could say, well, we should really do this to grow the value of the business to the financial planner. Financial planner who knows the CPA may go back to the CPA. That may not translate properly. That they may not necessarily have enough information to help their client make that determination or understand why you're doing it, and it just creates a lot of unnecessary communication, and unfortunately, you've just got to get people out of silos and functioning together to really help the business owner grow their wealth, which is the most important thing at the end of the day. It's not churning out tax returns. It's not selling product. It's ultimately making sure that company, that individual or that family has as much wealth as they can.
Good. Yeah. And ultimately, if you incorporate knowledge like this, then your recommendations, like Tom said, will have a lot of merit, and they should stick. And Tom, sorry the software didn't make you look so cool, but we still think you're the coolest guy on the block, Tom.
I still think I'm the coolest guy too.
Yeah, definitely best dressed today. You always get best dressed on these. I like the sweater, like the tie, looking sharp as usual, Tom.
Don't ask me to stand up though.
All right, don't do that. I won't. One quick kind of a side item, not really, not really much of a side item, I would say, because we did build this as a business owner and high net worth roundtable, and some of those issues do overlap. So can you explain how those concerns are similar, Tom, and how we can address the high net worth client who may not be a business owner per se?
Yeah, no, definitely. And there's a couple of things here that I mentioned when we were talking yesterday. And there's a lot of people there that have wealth. They may not be considered high net worth, but they have enough wealth where if there is the future of a lower estate tax exemption, which definitely will happen at some point, they would be exposed. So one of the things I find to talk to people that are probably in the $3 to $6 million net worth and above is I talk about setting up spousal lifetime access trusts where we could put money in a trust, the grantor being the spouse for his spouse, and indirectly that grantor would have indirect benefits from it on a tax-free nature for using life insurance. There is a downside. There's something called reciprocal trust doctrine, and there's also what happens if the spouse dies sooner than expected. But you can make that up by actually setting up another trust for each spouse. But it's a cool kind of thing that we have available where we can make large gifts of life insurance tax-free now and exempt it and be done with it. So we could actually set up an asset that will never, ever be taxed again, both on the income side of it and also on the estate side of it, but create great big benefits for the family members as a family bank. So it's a really cool thing. You know, you put 50 grand in for 10 years, you're going to create a lot of money over the next 30 years, that type of thing.
Mm-hmm. Yeah.
Yeah, I guess, and I do work with high net worth clients who are not business owners, and they still own assets, different types of assets, and you have to evaluate the strengths and the risks associated with those assets. But it's in some ways I guess it's a little bit easier because you don't have sort of the wild card of, really getting a strong valuation of the business, and you may be working more with publicly traded securities. But, to Tom's point, getting the assets out of your estate while the exemption is high, but at the same time protecting your assets. That's something that people lose track of sometime. I mean, having a trust in order to get your assets out of the estate is really important, but having it done in a way so that no one can reach those assets and take them away from your family is probably even more important.
Right.
Mm-hmm. Right. Good stuff. Good stuff. All right, great. So as we kind of wrap up here, one broad question, which I think is important for the advisors who took the time to be with us today, is just kind of tying it all together as the advisors who are wanting to help clients and grow their practice. So we'll pose a question to all of you. And if we have any questions, Maureen, Glenn, feel free to chime in as well. So how does all of this, how does tax law, how does business valuations, how does business planning, what type of investment, insurance, and planning opportunities does this create for our advisors?
You're asking us this question?
I'm asking all of you, yep.
Well, as a planner and an advisor, what I see here is, again, an opportunity to bring new knowledge to your client and really do some good work. And again, if you know this information or you have a handful of knowledge about it, it starts the process. You don't have to be an expert because there's people that could back you up and help you to guide you and the client in the right path. And I think don't be intimidated by all these terms and these tax laws. Be aware of them, but you don't have to be an expert. So I think it's a great opportunity for any planner, investment advisor to start bringing up these topics and opening the doors of better relationships because you're educating and you're planning for them. You're not just selling a product and that kind of thing. So I see the great opportunity there. It's a talking point that's very, very important.
Yeah.
Very good.
Good.
Hey, you know what? So that would be a segue for me, guys. Really, we've talked about a lot, right? Today we've talked about planning, business evaluations, incoming Trump administration. So many questions for advisors, I'm sure. So where do you go with your questions, right? And Josh, maybe you can help me speak to this, but we do have a business market coach program that Tom helps to lead for us. If you've got questions, you want to score meetings, book appointments, close bigger deals, this program could be right for you. I don't know if we'll share this in a follow-up email, but there are interviews between Josh and Keith and Tom. We do have podcasts to help you with some of these concepts. But I think, really the best thing to do would be to reach out to Josh and continue the conversation, start asking the questions that you have, and he can direct you to Tom and his team.
Yeah. And look at great careers have been launched and or taken to the next level, oftentimes because that individual, that agent or advisor decided to have a mentor in some way, shape, or form. So again, when it comes to business owners, if you have access to them or you're working with them currently, just don't wait. Approach them. Call us today. If you need advice on how to approach them, call us today. We can give you great conversation starters that are very simple and effective and will set you apart. If you are about to give a proposal or a quote for insurance or investments or anything else, if you're about to show that to a business owner, if possible, I would ask you to wait, call us, and see what Tom, Brian, or Ed sees in the situation that could turn a simple solution into a more meaningful solution for the advisor. It could turn a small case into a bigger case that could make whatever you're doing that much better in terms of the business you generate for your practice. But again, the idea is we've talked about the business owners tend to wait. They tend to wait. So they need you to be more proactive. If you have access to them or if you're working with them, call us today and let's hit the ground running for 2025 and get some of these cases in your pipeline.
Josh, can I add one thing?
Yeah. Oh, go right ahead.
Business valuations aren't static. I mean, if someone's not going out for 4 to 7 to 10 years, we have the ability, Ed and I can work with them to effectively help them raise that valuation. And one of the ways you do it is, through cost control. By controlling taxes and by controlling, other expenses, making sure your margins stay where they are, we can drive valuation. So that's part of it. I mean, you can show a client a plan based on what the value is now, but what's that plan going to look like if we're able to enhance that value? And I think that is what motivates people to do things.
Yeah.
Brian brings up a good point, Josh, because we're talking here about valuation as though they were going to have a transition. But what Brian just said is a living value that right now they could take advantage of to increase their value and profits currently. So it pays to have people talk to Brian and Ed about these topics and see if they're meaningful right now.
Yeah,
I agree. And Tom, to piggyback on that comment, some advisors are using that software that you described. If any advisor has a question on input for that software or want to have an independent review, I'd be more than happy to assist on that. send it to me, whatever, but I'll take a look at it and give you my insights on it. And Brian's point is really important because valuation is not static. It's as moving as much as a business is. And Brian's totally correct on discussing cost improvement. I do a lot more on the strategic side. Between the two of us, we've worked a number of different cases. So we look forward to
the idea behind the cost improvement is really just to have another pool of capital that you can invest back into the business for either an additional rate of return or to help kind of move those assets out of the business to create more diversity and ease that concentration issue.
Yeah, I love this stuff. And guys, advisors, if you sit in front of a business owner client and you give them this type of insight that they're not getting from their current advisor or anybody else, the good thing is that even if it's not a business case that's in front of you, that client's gonna open up their books to you. You become that person that advisor is gonna trust. So again, can't emphasize it enough. If you have more questions, if you have business owners, call us and we'll tell you how to approach them and get the ball rolling on this stuff.
Yep.
Everybody. Do you have some final words?
Are we ending, or because one thing I was going to say to Josh, have the advisors send, if they want to talk to their clients, I would think send them the link to this video so they can listen to what we talked about, just all these topics that we're talking about. That might help them, motivate them to start looking into things. It might be a nice opening for a lot of advisors.
Not a bad idea.
Yeah.
Not a bad idea.
The one opening I've found this year that's been really good is there's a new federal tax credit called the tribal tax credit, and that credit actually allows taxpayers to reduce their 2024 tax bill by about 30%. That's actually been a real door opener for us this year.
Good stuff.
Well, guys, Josh's QR code is up. If you take a snapshot of that, if you don't have his contact information already, and he will be very happy to assist you. So he'll get you access to this whole team before you. Don't be threatened. I mean, if you do have business client opportunities or business owner opportunities, we're here to help. So thanks for your attention today. We really appreciate you being here. And we will be doing this again in 2025, I sense, right? Also, don't miss what we have coming up in January with our Sequence of Returns webinar. So be on the lookout for that as well. But thank you so much, everybody.
Thanks.